The science of trading, or when trading becomes a science. Now, this comes to me as a realization of the style I would like to trade. The internet has created a route for many traders, a perspective for many traders to follow, and it assumes that's the only way. I was just listening to a podcast right now. It's a professor talking about his investment ideologies, and he speaks about how your investment ideologies change over time as you learn more, and your perspective also changes over time. You shouldn't be dogmatic when it comes to the market, and there's so much truth in that. Why do I say that? Why do I speak for that? It's because of my slow system. I hate my slow system. I hate my slow system. And the reason I hate my slow system is because when trading becomes a science, it's like amazing. Now, when I talk about trading becoming a science, I'm talking about trading from a technical point and a risk management point, and from a point of passion. When the technical analysis meets your risk management and meets your excitement of the game, and then everything becomes fluid. And that's why most traders aren't successful, because they have so many models that are good, and the risk measurements, risk parameter is also great, but the passion is not there. The passion is not there because it's not a perspective he or she wanted. Just like I don't want this slow system. But I'm glad I created it because it gave me so much insight on the market. Understanding the market ideology that every minute, every hour, every day is 50-50. Every trade is 50-50. Understanding situation, that your situation plays a role in your trading. You fund less often. It's harder to interact with the market because the market is based on real-time interactions. And if you miss real-time, you cannot interact with it. So it's basically things like that. How environment messes up your psychology, how funding messes up your psychology, how a tight trading plan is restricted by the market because you don't experience full market conditions. Things like that is what it taught me, which I'm proud of. But I never got into the market or got into trading to learn that. Yes, I wanted to be one of the best traders, but I wanted to be the best trader according to money. You know what I'm saying? I wanted a lot of money. And I performed a project with a friend of mine, with a homie of mine, I think about 5 years ago. Now, this project was based on some utilizing the same strategy again and again. But what I found out is, as much as you can follow your process, excellent trading changes as you partake in your goal. Let's say you have a set goal and a target, not even a set goal and a target, a goal with a designated time period. For the first few days, you're probably going to use your system. Obviously, now I can use my system because I have created more things. I have utilized my journal in different ways to, yeah, create something that's more logical, more comfortable, because that's what slow trading requires. When I say slow, I mean the profit approach is slow, the trade approach is slow, the goal approach is slow, allowing for survival and efficiency, freedom, removing things like fear. When your goal is extended, and when your sight is on the easiest trades available, what a good selection of pairs and suitable funding. The goal of achieving your trade goal or trade success becomes easier because already we know that the goal is money, but how you attain that money plays a role in the market. Now, like I said, I love trading fast. I love getting in and out. I don't mind losing 5 trades in order to get my big one trade, because it sounds bad when you hear it out loud, but when you actually trade, it teaches you the truth of what the market is, which is a truth that the slow trading doesn't have. And it's something that I didn't want to accept for a while, because we try to protect our trading systems. And then as time went on, I started creating trading challenges. And that's because we've been creating trading challenges. Now I'm talking about a company I used to work with other homies. We used to create weekly challenges as noobs in the game, as newbies in the game, because we wanted to accelerate our learning. If you want to learn how to trade, you have to trade. That's how the market works, because it's an interaction between your account and technical points, nothing more, nothing less. So you need to put your account to the test against, those technical points that are available. Now, your perspective drives your focus, and it's scary. Now, if I want to interact with the market from a perspective of patterns, I will see nothing but patterns in the market, and I will think that as the truth, which is not the truth. And I'll explain what the truth is. If I perceive the market as slow trading, which is discretionary trading, selecting the best trades in between multiple pairs, maximum of 3. I emphasize this because when I say multiple pairs, people will go 10, 20, 3 max. Remember, you're not trying to punish yourself. This is trading. This is your job. You're trying to be free while you trade, because the market itself is already hard. It's already tolling to the mind. So try to remove as many variables as possible around your work, yourself. But you will perceive the market in that perspective only, and you think that that's the truth. And the truth of the market is that it expresses price for each and everyone to take advantage of. And it expresses price in a window of time, 24 hours, 24 candles. You have the choice on how to perceive it. You can perceive it as shapes, as breakouts, as support and resistance. You know what I'm saying? Even though I still stand by the fact that support and resistance is not a true phenomenon in the market. It's general information. The market is trapped in support and resistance. It's general information, but it's not viable information. You cannot use it. And saying you took a trade at support and went to resistance and that's why it sold is incorrect. You took a trade at support because it was 50-50 when it got to that point, and it went up to resistance because the market is always 50-50. Now, when trading becomes a science, this is when I came to realize, which is something I came to realize today, because I've been trying to break down my systems. Now, when I say systems, this is a combination of your mechanical approaches and your risk approach. Your risk approach is basically how much you usually fund and how much pressure you usually put on that account. And then there's a bit of psychology here and there. That's why I say journal and categorize your journals accordingly. Strategies, goals, attempts, statements, evaluations, and all that. Do that, because this is your business. Every year you're going to have to buy a new book, a singular book, because there's always something to learn. Now, when I say something to learn, your journal also blocks out too much learning, because some people repeat information and all that, and that's unnecessary. If you know something, you know something. Now, back to what I discovered today, which I've been searching for the past 5-6 years, which is my fast trading approach. We were successful once, yes, with that friend, with that our fast trading approach, which is we combined each and every time frame mechanically. If the M15 has points to the downside, we'd connect that with a trend line. If the H1 has a W, we'll put out zone. Each time frame has its own trade, and would connect all those in sequence, and we'd say we'll only move. I don't know how to put it, but because the M15 breaks out and the H1 has this and that, on these trades will take them according to sequence of direction. If we see that one time frame is selling and another one is buying, we'll chill out. We won't interact with it. Now, the discretionary one allows that. It allows that type of hedging because we isolate time frames. Should I say I isolate time frames to, if the H1 has a W, I'm going to put pressure on that, make a profit from the H1. And if the M15 is selling, I will sell that. And I won't necessarily put that much pressure, even though I don't trade the M15. That's just an example. So we'd do that. And we'd leave those points on the chart until the market creates new points that we can interact with, or or until the market interacts with our old points. And then that's basically how it is. And the main point of this strategy was a singular stop loss per time frame. A singular stop loss per time frame, because that's the easiest way to trade, to not complicate. Isolate time frames to singular stop loss per time frame, which is the best way. And the reason I'm making this video is because I have an idea of how I am going to approach the completion. I don't know if I should say the creation or the completion of this this fast trading strategy. I'm first going to draw out my charts on a piece of paper. Again, the market has a few, it repeats a few patterns, and it's not reversal patterns or continuation patterns. Continuation patterns are derived from these patterns that repeat themselves. There's only 3 patterns in the market. It's the V, it's whatever this is in the opposite side. We'll call this a wave. It's a V, it's a wave, and invertedly, obviously. And it's flow, basically. Because at the beginning of these points, the market is 50-50 and could create or invalidate structure. For those who understand that statement, then you know what to do. Now, this is based on each time frame and how we're going to utilize these laws on each time frame. So this is another thing that the slow trading system taught me. Structure from this perspective. There's only 3 types of structures in the market. Fourth, with the spike, you could say that. You know what I'm saying? And another thing is the system didn't necessarily rely on invalidation. It relied on invalidation for entries, but for exit, it was more of aggressive exits, which is you have to be in the market and measure out your stop loss and say, do I really want to lose this? No. So I'll wait for the market to pressure, bait the market. It's another thing that people don't talk about in terms of trading, that you could put your trading on paper perfectly. But when you actually do trade and the market starts counteracting your confluence, not even a signal that you just guessed, your confluence so planned, immediately you enter a trade, it hits your stop loss. What are you going to do? You want to watch the market and say, no, I'm going to trade the next. And the next time it happens again. And the next time, because the market is 50-50. You can have 100 losses in a row. So it's not necessarily about confluence. It's about reaction. Do you understand the reaction of the picture that you are given by the market today? And that is based on the time frames you choose. If you choose too many time frames, you're obviously going to combine too many elements, and that's going to create confusion. If you choose too many small time frames, there's too many interactions, too many large time frames, too much bias mentality. So you need to have a balance. Now, this balance is not something I'm going to give out because I've been giving out gems. I've been dropping gems. These are my secrets, and these videos are for me. So, but yeah, that's basically what it is. Take it easy and create a journal. Break it down into categories and put it to the test. It costs nothing to trade your demo account. It costs nothing to put your strategies to the test. But it costs everything to not find out how well they work. And you need to also understand the abstract part of trading, which is not necessarily psychology, but it's how you interact with the market intuitively on certain trades where you can actually sense that this is not trading on my time frame. I have to go to a lower time frame to get an entry. And things like that people don't write down. People don't record. And it saves you a lot of money and time. Science of trading.